Good morning, everyone. Welcome to the Bowen Coking Coal webinar. Today's host will be the CEO, Mr. Daryl Edwards, and our Executive Chairman, Mr. Nick Jorss. There'll be a Q&A session at the end of today's presentation, where we'll be answering questions. I'd like to reassure everyone that of all the questions we've received during the week, they will all be answered by the end of the week if they aren't answered today. Without further ado, I'll bring on Mr. Edwards and Mr. Jorss to walk through today's presentation. All right, if you could, gentlemen, like to start.
Thanks, Gareth. It's a pleasure to be here this morning and to talk through the equity raise. This is the final step in strengthening our balance sheet, having renegotiated our debt on favourable terms and done a lot of work to really right-size and fix this business. I will acknowledge up front that this has been a difficult time for the company, obviously for our shareholders in particular, and I will assure you that the team has been working very hard. We have a tight, very focused team, and we're working very hard to restore that shareholder value. So I hope by the end of this presentation you'll agree some of the initiatives we've taken are actually bearing fruit. And now I think, where we sit today, where we wanted to be in terms of the sustainable long-term operations of the business. So the business is now in the best shape it's ever been in an operating sense. We are now going forward. We're a low-cost operation. That hasn't been the case in the past as we've been in startup and we've been hit with a number of different issues. But now where we sit going forward today, we are in good shape in an operating sense. This equity raise is not about business performance. It's about strengthening the balance sheet and getting us in a strong position to take the business forward. So there's been a lot of focus, as I say, the team working very hard to take cost out of this business and streamline it and bring it to the business we want it to be, which is a low-cost, medium to long-term operation, which gives us very good leverage to what we think will be an increasing coal price over time, which is why we're all in this game and why we're investing in this sector. The cost initiatives have basically gone in three buckets. The first and the most important is the mine plan. So this has always been our plan to get the strip ratio down to 7:1. Because this mine is a terrace mine, so we just mine along strike. We don't go down dip and get deeper every year, unlike most of the mines in the Bowen Basin which do that. We set our strip ratio, we set our high wall, and then that sort of dictates our costs going forward. So we've targeted 7:1. We're now at 7:1. So that has come down markedly in the last 12 months. If you go back to the beginning of last financial year, we were at north of 15:1. Bluff obviously was much higher, strip ratio operation, much higher cost. That's been shut down effectively and it's no longer an operating asset. But from here on in, we're at sub 7:1. In fact, at the moment, we're running around 5, just over 5:1 in the Ellensfield pit. Going forward, Ellensfield comes down to as low as 3.1:1 in what's left in that pit through to June next year. We are starting up Plumtree, but our mine plan is such that we stay under that 7:1 strip ratio through that transition. So the cheap 3:1 dirt we mine in Ellensfield makes up for the box cut in Plumtree. So look, that's the key thing. It's strip ratio that drives our economics. Every BCM, every cubic metre we have to move of overburden to get a tonne of coal costs us around $7 total, around roughly $5 incremental cost. So that's the first point. The second point is the operating cost savings. So Daryl and the team have done, I think, a very good job, and he'll run through the particular initiatives, but there's about $15 to $21 of cost savings identified through that. We're a fair way down that track with the actions we've already taken, which Daryl will run you through. we've pulled about or identified about $10, which will come out with the capital we've already spent and the actions we've taken. The third aspect is corporate costs, overheads, but not just overheads. We are very, we run a tight business. We have a small office in Brisbane, and we have a tight team. We watch every dollar. But importantly, it's also our debt costs, our financing costs. And so we've renegotiated those. That took a fair bit of work. But the good news is our debt providers, our financiers have been very supportive. They continue to be very supportive of this business. You'll see they've converted debt into equity, which is a great sign for their confidence in the value of the equity in the business at the moment. And the renegotiated terms we've got with Taurus and New Hope, net across both of them save us about $5 to $6 a tonne. It's about $34 million over the first 3 years. So we've wiped out all the acquisition royalties. From buying it from New Hope, buying the asset, we've wiped out deferred consideration. And brought interest rate down markedly from basically north of 20% effective rate, including redemption premiums, to down well into the single digits. We started at 4% on the New Hope interest rate there. So look, Darryl will take us through the detail, but I think the message I want to get across is that the operations are now performing strongly. We've got record ROM coal mined in Q4 of FY24. We've got, we're at low strip ratio. Over 60% of our coal is coking coal. That's our target. We're there now. Our mining rates are good. So the last 4 months through to the end of August, we exceeded our 250,000 tonne target. We hit around 311,000 tonnes a month. So that has meant we've fed coal into the system. The wash plant's working extremely well. We've as you know, we've refurbed the first module. The second module is there to be done if and when we decide to do that at relatively low cost. But that wash plant's working extremely well, going over average feed rate of over 400 tonnes per hour and fully utilised. That's been a fantastic asset for us. In terms of coal production, we're on target, about 150,000 tonnes a month for the past 4 months. Sales were a bit down in the last quarter, but we're making up for that in this quarter. So a consequence of all of that, our stocks are healthy. So at the end of August, we had about 1.5 months on the product stockpile and 154,000 tonnes of ROM stock as well. So plenty of feed in the system. As I said, strip ratio, that's the game. That's really what we focused on, our mine plan to bring these costs down, and that's just kind of mathematics that drives the lower cost in this entity going forward. I talked about cost initiatives. I've talked about a little bit about the debt. We'll touch on that a bit more on the way through. I might hand over to you, Darryl.
Thanks, Nick. And thank you everyone for joining. So I'll just flick through the next couple of slides, give us about half an hour if that's okay, and we leave some time for Q&A at the back end of the presentation. So just as a refresh and a reminder, let's just remind ourselves of what we've got at the Burton Mine Complex. So we refurbished infrastructure, and to date that has a valuation or a value worth circa $500 million worth of refurbished infrastructure. And if you take the reserve life that we've got there based on the current mining rates, that gives you circa 13-year mine life. So that's what we've got. And then the map on the right-hand side, if I can just walk you through that map briefly, if you don't mind, just as a refresh. So the map at the bottom, if you can see the cursor, great. Otherwise, I'll talk you through the coloured dots. So the coloured dot, the purple one that you see at the bottom of the screen, that's the train load-out facility. That's what we call the Mallowat TLO. And that is linking up to the Dalrymple Bay coal terminal. So that's where we transport all our coal out of. And the blue line that you run up to the northern area of the map, that's a dedicated haul road. So currently we are running 6 dedicated haul trucks along that haul road, and all the actions happening up at the green dot at the top. So that's called the MIA and the Burton CHPP. That's our coal processing facility. Immediately to the south of that is the Ellensfield South mine. So that's the pit we're currently in, and we're currently producing coal from that pit. And then immediately south of that is the Plumtree North deposit, which we're busy digging the box cut at that asset at the moment. The northern assets, we'll spend some time on this, just talking about in the presentation, but certainly Lenton is definitely part of our plans. This is it needs one more license, which is the EPBC approval license, which we are busy with. The rest of the assets are important into our coal flow and preparation and plans. The Isaac asset, which sits is the orange dot at the top, which is just north of the Isaac River. Certainly a really exciting prospect for us, and we really want to do a bit more work on that one to bring that into the production profile. So that's what we got. If you come up the Hall Road, you would have gone past Broadmeadow East. You may have seen earlier this year we put the Broadmeadow East asset on pause. The reason why we did that is Broadmeadow East doesn't produce sufficient coal to fill the wash plant as it stands at the moment. So we can do that out of Ellensfield South and Plumtree. So our focus on this business is to streamline the production, to produce the coal that we want to fill the wash plant, to make that the bottleneck of the entire process. And we do that with the assets that are closest to the CHPP and also the better quality coals for us. So Broadmeadow East is on pause at the moment. There's a power line that traverses that lease. We do need to move the power line in order to mine south. But that's something that we want to do in the future. It's basically an upside for us at the moment, rather than mission critical. So our focus is sitting in the northern assets, and we'll try and bring Broadmeadow East back into the production profile in months and years to come. So just as a reminder of what we've got again, so in terms of numbers, the reserve base, as we stand at the end of June 2024, is 35 million tonne reserve. Now, these are all JORC declared, and this is all available on our website and that we've published already. At current production rates, we're producing circa 2.8 million tonne per annum, which is the same capacity as the wash plant, Module 1, that you can see on the right-hand side. And that produces a saleable coal product of circa 1.8 million tonne. So that's in line with our guidance that we've provided for the next financial year. So for FY 2025, that's the guidance. And at current production rates and that reserve life, that gives you circa 13 years life of mine. So just the photograph that you can see on the right-hand side for everyone's benefit, where you can see the lights are on. So that's Module 1, that's facing us. So we've obviously, that's been running for quite some time now at a steady state basis of 400 tonne an hour. So we're very happy with the performance of that wash plant. And I'll talk a bit more later in the presentation around availability and utilisation, which are key metrics for us. Just at the back end of that photograph, you can see Module 2, where the lights aren't on. There's a lot of componentry that we've already procured that's on site already, but we haven't connected up Module 2. So we wanted Module 1 to be the bottleneck of the system, which we're proud to say that is basically what has been achieved to date. Then we'll just run through the capitalisation and the equity raising in a bit more detail. So Nick touched on some of the financing activities that we've done in the equity raising that we're busy with currently. So what we've done is we've renegotiated our senior facility and our subordinated facility. And our calculations, what that equates to is circa $34 million of savings to June 2027. Now, what have we done? So the blue bar graph on the graph on the right-hand side. So the blue bars are for Taurus, that is our senior lender, and the yellow one is for New Hope, that is our subordinated lender. And then we have a convertible note which sits in the debt stack that is unchanged, that sits at June 2027. So what have we done with Taurus? So Taurus, you've seen the dotted lines is what we had before, the renegotiation and the heads of agreement that's been signed. So effectively, we agreed a 9-month deferral on the Taurus facility. And what that meant is we've been able to sculpt our payments. So you'll see instead of a straight line profile on the debt repayments, we've now got a sculpted profile, which calendar year 2025 is largely reduced compared to calendar year 2026. And then importantly, Taurus has opted to take equity in this capital raising up to the tune of $10 million Australian. So they are happy to underwrite and have underwritten part of the equity raise. It's obviously subject to a few conditions such as shareholder approval and potentially further approval if required, but certainly Taurus is supportive of our business. And importantly, the next debt repayment for us happens at March 2025. And Sorry.
Yeah, I was just going to say on the sub debt, the New Hope piece, 45. So just so people are clear on that, that backs our rehabilitation obligations to the state government. And there's another $20 million we've put in cash to back that as well into the government's bank account. So, we are hopeful in due course under this government or a future government that we are able to access the financial provisioning scheme, which is a insurance scheme designed in theory for people like us to be able to access and pay a relatively modest insurance premium instead of putting up cashback, surety and these bonds. So that is our goal in the sort of next year or so, is to get that into that scheme, which would mean that $45 million, if we could achieve that, would then go away, or would be part of the scheme.
So just flowing through on the financing update. So at June 2024, we had total debt facilities of circa 129 million of secured facilities on the balance sheet, with convertible notes of $40 million. So just flowing all of that through on the negotiations that we have managed to achieve, that sits at now circa $98.7 million for the secured facilities and $40 million unchanged for the convertible notes. So what's happened here is on the Taurus facility, currently we have $44 million principal outstanding. In September, we paid $7 million back to Taurus. So from 51 US to 44 US, we paid that back in September on the back of a 10% sale of Broadmeadow East. And what we've done with Taurus is we've also had a modest increase in the margin and the royalties. So the interest rate margin has gone from 10% per annum to 11% per annum. And the royalty that Taurus levies on us for the facility has gone from 0.75% to 1%. We're also going to issue Taurus 0.6 million or $600,000 of equity as part of the capital raising process, as part of the transaction costs for that facility. On the New Hope facility, or the subordinated loan facility, there's basically twofold up here. So the New Hope exercised the warrants at the back end of September. The date was the 27th. And they exercised $81.3 million of those warrants. And what that did is that basically took out the third line that you can see on your table. So the subordinated loan facility, which is capitalized interest and redemption premiums, by exercising those warrants, we've wiped that off the balance sheet now. Obviously, New Hope has been given equity for that, but we've completely reduced that component that was on the balance sheet. And the second component of that is when we acquired the Burton assets of New Hope, we agreed deferred considerations or milestone payments together with acquisition royalties attached to all coal sales. Now, what we've done is we've managed to agree with New Hope an issuance of either cash or the issuance of shares for circa $8 million. And what that will do, that'll nullify all the outstanding deferred considerations and any acquisition royalties on the asset itself.
Yeah, that's roughly 34 million or so over 3 years. So it's quite a substantial reduction in the cost of that facility, or in the cost of that those royalties. And also, I think Daryl, as I said earlier, our interest rates has come down markedly on the New Hope facility.
Just a point to note on the slide, there might be a little bit of confusion around it. So the debt renegotiation and restructure is premised on the basis of Bowen raising $25 million as a minimum. However, the Taurus opting for 10 million of equity is conditional on $60 million as a minimum equity raise. I just wanted to clarify that if there was any confusion. So flowing through to the equity raising, Bowen is seeking firm commitments to raise up to $70 million Australian before costs through a renounceable entitlement offer. So that is partially underwritten, and it's $70 million Australian, which equates to 2.6641 pro rata entitlement offer. The offer price is 0.009 per share, which is 0.9 cents per share. That is a 25% discount to the last traded price of 1.2 cents on the 13th of September 2024, and it represents an 8.3% discount to the TERP of 0.0098. So importantly, what we've done as a part of this offer and the structure is for every 2 new shares subscribed, there will be an accompanied 1 free attaching unlisted new option with an exercise price of the same issue price of the offer price of 0.009 per share per option, expiring 6 months from the date of issue. Importantly, the offers are underwritten to the tune of $10.5 million from major shareholders, and those are the Crocodile funds. There are 3 of them, and $30 million from new strategic shareholders, being Taurus, which we mentioned on the previous slide, and Square Resources. And we'll talk about Square in a bit more detail on the next slide. So just importantly, on the convertible note, we mentioned there on the previous slide, there is no change to the tenure of the convertible note, but what does happen as part of this equity raise is there's a protection under the conversion price. So that conversion price will change, be expected to change from 26.37 cents to 0.0786 or 7.86 cents on or around the 30th of October 2024. So what we've got in part of the equity raising is a minimum of 60 million Australian. If that is not reached, the offer will not be underwritten and Bowen will not proceed with the entitlement offer. So no new shares or options will be issued under this structure. And I just want to mention that under this scenario, there's no assurance that the company will be able to obtain sufficient alternative sources of liquidity within the time period required, in which case the company may not be able to continue as a going concern. But we're obviously focusing on a number of liquidity initiatives, which we are busy with. This equity raising is part of that. So on the equity entitlement offer of $70 million, just running through the table on the right-hand side, so the source of funds is entitlements of 70 million Australian and a cash balance at the end of June of 21.7 million. And the uses of that capital is predominantly going to the Plumtree CapEx. So we'll talk quite a bit about the Plumtree CapEx as part of this presentation. So net of revenue, use of proceeds is $43.5 million. Port prepayments and rail guarantees is $10 million. Transaction costs are $5 million. And the balance is working capital and cash to balance sheet liquidity of $33.2 million.
Fair to say, Daryl, the transaction costs cover the debt and the equity side of that restructure. Yeah, thanks, Daryl. Look, we have, as part of this raise and moving forward with the business, we have agreed to appoint Square Marketing as our in-house marketing, sales and manager. So as part of that, they've agreed to put in $20 million into this capital raising. Square are a very accomplished and well-known marketing company based out of Brisbane, but with offices around the world, some 45 plus employees. They're very well connected in the market. Where they worked when I was running Stanmore, they were doing the marketing there for Isaac Plains when we kicked that off. They're doing all the Foxley marketing. They're selling coal out of the Americas and out of Asia and Indonesia and Australia. So that we're excited about that opportunity to work with these guys. There is a bit of a crossover in compensation for our previous marketing supplier over 12 months. And Square have also given us a short-term loan, which is part of our sort of normal receivables management and financing, which we were doing with the previous marketing provider. So that loan, $11 million we've received. I think now we've paid back now as well, Daryl. So yeah, so look, that's all working well. There'll be a 3-month period before that kicks off formally, and then the 12 months overlap.
Thank you, Nick. So we'll just run through a few performance slides. This material has been released to the market previously, so you may have seen this material already, but let's walk through the slides. So I'm not going to spend too much time on this slide. This is all historicals, FY 2024 production results. But importantly, on the right-hand side, I just want to talk through the tale of two halves. So half one, FY 24, we saw an EBITDA loss of $26.3 million, whereas in the second half of FY 2024, we saw an EBITDA profit or a positive EBITDA of $12.9 million. So, definitely a tale of two halves from a performance perspective, circa 149% improvement between the two halves. So those are the audited results that are pushed through. So just drilling through a bit of FY 2024 results again. So what we got, the graph on the right-hand side has been published previously. Just I want to touch on a few points. So this business is highly leveraged to the coal price. What we've seen in the March 2024 quarter, we were at $277 per tonne is the basket price, with a cost of $182 a tonne. And we saw that dropping into the June quarter. So June 24, we saw that basket price drop to circa $228. And we have seen some weakness from June 24 up until now, and we've probably seen that turning a little bit again in the right direction. And Nick can talk to you a little bit about that later in the slide. But certainly that shows you that when prices do turn, that leverage is definitely there, and the exposure to the coal price is definitely there.
Yeah, I might just pick up on that pricing issue now, Daryl, because I think you're quite right that we are leveraged to coal price. The 277 to 228 from March to June quarter, obviously a drop of about 50 Aussie dollars. That's obviously a lot of real money for us. Annualized, it's close to $100 million of revenue, which drops to the bottom line. In terms of the cost, just bear in mind, I think the June quarter we had a number of one-offs in that 218, and bear that number in mind when we look at the charts coming forward, because our cost going forward we see this year is 145 to 165, and we see beyond that sort of 145 to 155 is what we're guiding, Aussie dollars plus royalties. So we are now in a situation where we're seeing coal prices starting to turn. Post the June quarter, they came down further, as Daryl said. We'll announce that in the quarterly as to what our average price was, but it's obviously materially has been below what the previous quarter was. But since the bottom in the last month, we've seen physical prices jump by for PLV, for prime low vol, and remembering we're selling low vol, which is a slightly different quality. But in terms of the index that you can track on a daily basis, PLV's jumped some $40 since the bottom in the last month. So Australian $40 since mid-September. The paper market and the futures market is suggesting that will continue. Certainly, this is the time of the year when we see more buying coming out of India, typically potentially some wet in Queensland and strengthening the prices. So normally we get much higher prices through the end of the year. The paper market's suggesting, again, it's all public information, but there's potentially another 35 Aussie dollars through to January on the PLV price. So we're in a good situation now with our costs down. We'll talk to that, and that's a sustainable through the cycle of cost. And we think the price now is showing signs that it's certainly bounced materially, and it looks like it might continue.
I just want to touch on this quarterly performance. So, we've been in the market previously. We've been talking about improving performance, and what we say by that is we've been talking about reducing strip ratio and increasing tonnage, streamlining the business into one production pit. So this graph pretty much talks to that story. So we also been talking about improving our coking coal to thermal coal ratio. So what we have done is we've gone from 15. This is just the Burton complex, right? From 15 to 1 strip ratio down to circa 6.7 for the last quarter. We're predicting circa same sort of numbers going forward into FY 25 quarter one. So strip ratio has come down, as Nick spent some time talking about, and that leads to cost reduction and recovery. And certainly thermal coal's been a big part of our initial kind of startup, but since that wash plant started settling down, we've managed to get the thermal coal component down, and we're prioritising coking coal. So with that, we've managed to get run-of-mine coals all the way up. So run-of-mine coal we were struggling with. As I mentioned earlier, we're battling to pull the wash plant and make that circa the bottleneck within the whole process. And we're proud to say that we've now managed to do that. So quarter four and quarter one for FY 25, we're really happy with the performance so far. So we said we're going to do it, and we've done it. And this is now looking forward at steady state production for us. Just touching on the cost reduction initiatives, this has been a big focus of ours. So we put a table in there so everyone can see what we're busy with. And I'll talk you through each of those points, but certainly it's easy to talk to a picture as well. So if I can just guide you to the bottom right-hand side of your screen. So what we've done is we've changed trucking contractors on the site. We were hauling coal all over the place. So if you remember the map, right in the beginning of the presentation, we were hauling coal from Broadmeadow East up to the CHPP. We were also hauling coal from Ellensfield South to the CHPP, and then from the CHPP down to the train load-out facility. Well, as of today, the only way we're hauling coal is one way. So we're hauling product coal, which is in the photographs that you can see at the bottom of the page. We're loading product coal into these trucks, all standardized trucks. We've got 6 trucks, all exactly the same size, and they're just hauling product coal down to the train load-out facility. So that, changing that trucking contractor out and direct haulage down to the TLO circuit, taking about $6 million a year of annual savings, which we're anticipating. Together with that is, instead of hauling coal in those trucks from Ellensfield South up to the CHPP, the coal's coming up in the back of the rigid truck. So as it's coming out the pit, instead of dumping on a pit ROM top that's staying in the truck, we're doing circa 2.5K haul to the wash plant. So as you can see on the right-hand side, all these little dumps of coal over here is all straight off the rigid, and that gets fed directly into the CHPP, which is sitting on the left-hand side. So direct hauling of the run-of-mine coals takes circa another $4 million of cost out of the business. So straight away, there's $10 million of cost savings, which we should be experiencing as we speak at the moment. Another big factor of ours is, so everything that gets fed into the wash plant, obviously we produce product, but we also produce rejects. Now, the fines rejects have always been pumped to the discard facility. On the coarse rejects, we've been handling those from when we started. So that's everything plus 20 millimeters. We've been picking up with a front-end loader, putting it into a Moxie. That Moxie's been taken around to the discard facility. So what we've done is we've installed the rejects crusher. So it's basically a sizing machine which sizes all the coarse rejects down to circa minus 20 millimeters, so we can mix it together with the fines, and then we'll pump all of that out to the discard facility. So we're in the process of commissioning that machine now, and then we'll get rid of the Moxie and the front-end loader. So that'll save us about $4.5 million a year. So that is actually being commissioned back into the September quarter, and we've just gone a couple of days into October, so we're still busy with that commissioning phase now on the reject crusher. Then while I've got the 2 photographs here, I just want to show you there's these bins on the right-hand side. So the one of the bins belongs to Module 2. That's not in operation, but these 2 bins on the left-hand side of the photograph are in operation. Traditionally, when Burton ran haul trucks here, they used to load their trucks directly out of the bins. We want to do the same. So what that means is we need to reskin the bins, and the steel for that is actually being procured already. It's on site. We just got to put it in place around the bins. And we actually want to put the trucks under the bins to be able to direct load the product into the trucks so we can get rid of this front-end loader. So with that, we anticipate about a $2 million a year saving. And then right across the business, all mobile equipment. So we've got dozers on site, we've got loaders, and we've got watering trucks for the haul road. All of that has been requoted. So we've retendered and requoted all of that mobile equipment. We're actually in the quarter now where that change out is busy happening, as well as haul road maintenance contractors have been changed out. So we've gone through all the contractors on site. New contractors have come onto site. Existing contractors have had to requote, and those that aren't competitive have left site. So we've gone right through the business in cost reduction, right from the top to the bottom. And that doesn't just stop there on site. It stops with us in Brisbane. So as Nick mentioned, we've got a small office in Brisbane. So overheads we're targeting across the entire business between here in Brisbane and everywhere within our business. And then the last saving that we're still busy focused on is about $4 to $6 million. Effectively, that's not going to happen this financial year. It'll only happen from next financial year onwards. That's if it's committed to, and that's connecting the entire business up to state grid power. So it's still something we're still busy with. As I say, it's not going to happen this financial year, but it's definitely something in our sights that we'd like to achieve. This is a graph we put in for the first time. I think a picture tells 1,000 words here. So You can see the concertina effect at the back end of this graph, and this is all our vessels that have been waiting for coal. So as you know, at the back end of the June quarter, we had really healthy product stocks, we had really healthy run-of-mine stocks. And in July, we only got one vessel away. So this vessel in July was the only one that got away. We anticipated getting a few more away in July. So the back end of the quarter, those vessels got away, fortunately. So September was the best quarter that we've had ever, with 5 vessels leaving. But overall in the quarter, we're still expecting 9 vessels for the September quarter. And looking forward, October is looking pretty good where we're sitting at the moment. We've got healthy stocks, as Nick has mentioned, and we're well positioned to be able to deliver into the vessels. So previously we've had huge rain disruptions all the way through the beginning of this calendar year, and we got to a point in June where we're well positioned to be able to cater for that. We experienced some rail delays which caused the concertina effect, but we're in a really good position now. So we've got healthy product stocks and ROM stocks to be able to cater for this going forward.
So Daryl, the infrastructure issues around port have eased. We saw a shiploader out. We've seen issues on the rail line, which now we're seeing people offering us capacity. So that's really turned around markedly in the last couple of months.
Yeah, the system's definitely improved. Just on outlook, so this is, as I said, this has been released. So FY24 actual is on the right-hand side of the table. Where we are on FY25 plan is managed ROM production between 2.7 and 3 million tonne for the year. Managed coal sales equates to 1.6 to 1.9 million tonne at a unit cost guidance of 145 to 165 per tonne. And the capex guidance is 65 to 85 million Australian. So of that capex, I just want to guide your eyes to the third bullet on the right-hand side. So of that capex, 80% of it belongs to the Plumtree North box cut. So that's why we're in capital raising at the moment. It's for that box cut, and it's for Plumtree North. So that's the majority of the capex for this financial year. The balance of that capex, so circa 20%, belongs to other capital items which are part of sustaining capex for the financial year. And going forward, just our forward projections are 145 to 155 per tonne, excluding royalties from FY 2026 onwards.
Daryl, that box cut capex, in an ideal world, we would have funded that out of cash flow. You saw the prices come down from March to June quarter, which kind of crimped our ability to do that. But what it does do, and we'll see this in the following slides, is it sets us up really well for low strip ratio coal going forward for the next 5 years. So sub 7 to 1 or around 7 to 1 for the next 5 years through that end of Ellensfield pit and into Plumtree pit, which is a long-term, much longer-term pit for us. So it puts us in a very strong position to keep our costs down for the next 5 years.
So that's a production performance, FY24 historical, and also looking forward, this is our outlook for the next financial year. Just importantly, you'll see the dotted line and the solid line. Those two lines, the difference between the two is the inclusion of Plumtree capital. So on the dotted line, that is Ellensfield South, and that's what we're forecasting for the balance of that, the life of that pit. And then if you add the two together and you include Plumtree, you get to the solid line. But importantly, all the way through, you'll see below 7 to 1 strip ratio, which is our target, as we've said a number of times. But also, you'll see the coal flow. So the light blue bars show you the Ellensfield South coal coming through, and the dark blue shows you when Plumtree coal comes through. So importantly, we need to start Plumtree now in the dry season to be able to ensure continuity of coal flow. So if we waited for the box cut, we would have had an interruption of coal flow at the back end of the financial year. So that's why we started Plumtree capital box cut already. So what that does is that production profile then translates into a cost overlay, and that cost overlay looks something like that on your screen. We've spoken about FY 2024 already. We've spoken about an extra $33 a tonne in FY24 due to haul road and rectification works. A lot of demurrage that we incurred as part of that. But going forward, we're forecasting 188 for this quarter, and from then onwards, circa 150 and 140s for the balance of the financial year. So as you go to that lower strip ratio at Ellensfield South, you should see that cost profile reducing quite substantially as part of that outlook. So this is Plumtree. This is basically what the investment in Plumtree relates to. So what it delivers. So obviously our mine planning is telling us that this is the production profile that follows from the activities of the box cut. Once again, below 7:1 strip ratio and circa 5 years life of mine coming through from Plumtree North. So this is the reason for the capital raise. To be quite blunt, this is what it's for.
Yeah, so as I say, that really does set us up well for the next 5 years. I mean, sub 7:1 strip ratio is very competitive in the basin, and as I alluded to earlier, a lot of mines already double figures and getting deeper every year as they go. As their strip mines, they go down dip, whereas we go along strike, and so we set our strip ratio and we keep it constant. So this really is the sort of superpower of this mining complex, through the next 5 years, and then Lenton comes after that, and it's similarly a 7:1 strip ratio once we get the final approval on that. So we do think we're really well set up there. I mean, in terms of comparative costs, you guys can look at it yourself. I mean, we're seeing costs around sort of between where we are at the bottom end and up to sort of around $200 a tonne ex royalties in the basin, and that's just from all the publicly released information from the Peabodys, the BHPs, the Coronados, Anglo, Whitehaven, Stanmore, etc. So that information is out there, and we're very comfortable where we sit towards the bottom of that range of what people have been doing historically in the last sort of half or 12 months, and what they're kind of guiding to do in the next 12 months.
So with that production profile, this is what we've got in terms of infrastructure and the CHPP. So solid bars is what's been installed already, and the solid horizontal line. So that's module 1 capacity. The dotted line is if we had to connect module 2, that's where the capacity would be, as well as what you'd need from a run-of-mine coal flow perspective. So certainly some incremental run-of-mine coal flow, which could potentially come from either Plumtree North or turning Broadmeadow East back on again, as I've said before, with other areas in the Burton complex coming into the fray. So Isaac Pit and potentially Lenton and Burton North, and Lenton subject to EPBC approvals. So that's the profile. That's what it looks like going out. And then on the right-hand side, we've given the market some indication on CapEx. So we've guided between $12 and $15 million to get module 2 up and running, and then a permanent power connection at Burton. Once again, on the cost reduction slide, we spoke about that. So we anticipate between $8 and $10 million to be able to get that done. Broadmeadow East power line, if we wanted to bring BME back into the production portfolio, we'd have to move that power line, and there's some ERC that needs to be environmental rehabilitation cost that needs to be provided for that. And Lenton, we've given some guidance around CapEx, anticipated CapEx to get Lenton EPBC done and some road diversions and infrastructure done in Lenton between $45 and $59 million. So that's the enabling CapEx that we see in the business going forward.
So Darryl, we don't draw on that Lenton coal under our current mine plan for a number of years, but that CapEx is therefore optional, subject to getting final EPBC approval. Same with the BME power line, that's at our election. Permanent power as well. Obviously, it's a short payback period, and that's something we want to do, but these are all kind of things we can do to enhance efficiency, bring down costs, extend mine life, etc. Lenton we will do once we get the approval through, but that's at least a couple of years away. The module 2, as you say, $12 to $15 million. The back has been broken of that. That doubles our production. So that is important, because I think we all believe, and certainly the market soundings we hear is that we will get more spikes in prices as supplies continue to be depressed for a number of reasons. Big one of them being ESG reasons and inability to get approvals and get finance. And demand continues to grow. So we see that optionality as being quite valuable to be able to very quickly and cheaply double production from the existing infrastructure and existing reserve base.
Next. Just touching and zooming in on the operating overview just to date. So I'm going to run through these pretty quickly to leave some time for Q&A. So remaining strip ratio at Ellensfield South, 3.1 to 1 at the end of August 1st of September 24. Remaining coal reserves are 2.1 million tonne. So far we've mined 3.575 kilotonne at that same date cycle, first 2 months of FY 2025 with 200 kiloton of sales. Importantly, we've got 3 excavators there with a full truck fleet. And there is a standby excavator which is available to use during downtime or maintenance time on the other excavators. But also, if we wanted to ramp up production, at least there's an additional excavator on site already. We've had good weather. We're collaborating well with a mining contractor. We've got a focused management team. We've changed out a number of personnel on site, and it's working really well at the moment. ROM stocks on hand was 154,000 at the end of August. And we started some coal auguring at Broadmeadow East just to supplement some of the coal flow for circa 6-month period. Sorry, I just want to go back to the previous slide. So just in the distance, so those of you who don't know, so this is the Ellensfield South Pit. If you can see my cursor at the top end of your screen, there's a row of trees, which is called the Teviot Creek. In the background there, where we're busy clearing the land, that's Plumtree. So that's actually where the Plumtree asset sits, just for some locality. And if we zoom into that area on that photograph, this is what it looks like now. So we've started the topsoil clearing. We've done the first free dig pass that commenced in the September quarter. And at the moment now we're busy excavating the box cut there as we speak at Plumtree North. So 11 million tonne reserve, circa 5 years life of mine at the production targets, and first coal is expected in Q3 FY 2025. And as I say again, we started Plumtree now in order to maintain the coal flow throughout the financial year.
Yeah, so first quarter next year we should get this calendar year, get some coal out of that.
This is one point I do want to make. I mean, this is the wash plant. So importantly, we've said a number of times that we want this to be the bottleneck of the system. In the March quarter, this utilisation of this facility was 73%. So we've had a marketable change in improvement in the utilisations here. So big focus on this asset being the bottleneck in the system, making sure we've got run-of-mine coal, making sure that it's available so we can use it. For example, when it's raining, at least we can run the wash plant. So obviously, mining will stop depending on the level of rain, but we can carry on running this wash plant while it's raining, so we can still load coal into the ROM bins over here and produce product coal. So importantly, we don't want to lose time on this wash plant, because every hour we lose is an hour lost of revenue. So product stocks, and that's why, because of that healthy utilisation rate, that's why we had 244,000 tonnes of product at the end of the quarter. So that equated to circa 1.5 months of saleable coal production, which is positive. So in end of August, we're really healthy product stocks. So we've done an audit on the system. Just want to let you know that. So we're looking at yield improvement throughout every single circuit within that wash plant, as well as throughput. So we are looking and seeing what we can do in terms of expansion of module 1 before we look at expanding module 2.
Yeah, I think we might wrap through this pretty quickly to leave the Q&A. So this just kind of talks about where the coal is sold into, and I think we've done a good job getting that coal into the major steel mills in Asia in particular, but also in Europe, and the thermal coal also kind of going into good spots as well. So that's been a success. We'll talk about pricing just quickly. You saw the kind of energy crisis linked highs there in sort of early 2022. We have seen prices kind of jump around a fair bit. They've obviously come off lately, but we're now seeing them, as I say, tick up again pretty substantially, and we're seeing some signs that will potentially continue. So even a 5500 thermal, which is what we're marked on, is sort of creeping up as well. So I think what the other point I'd make here is that what used to be considered a low cost mine or a cost base that was acceptable, now costs have literally gone through the roof. It's world record royalties in Queensland, but it's also just all the input costs, labour costs, and everything else have gone up. And the physicals, strip ratios are going up, as I say, every year. So now seeing somebody with a cost below sort of 150 Aussies on the boat, ex royalty, is extremely rare. So I think you will see, given Queensland does tend to set the clearing price for coking coal in the seaborne market, you will see upward pressure on that price. We were in a similar situation in 2015-16, and when at Stanmore, when we bought Isaac Plains, and we were down in a situation where people weren't making a lot of money, and even BHP was probably losing money at that point in time. And then we very quickly saw the price shoot back up to sort of $300, within sort of 9 months of that period of time. So hopefully that's where we are. Just long term, you guys know why we're so passionate about this as a commodity. Steel demand's forecast to grow 30 to 60% by 2050. That's not just industrialisation; it's decarbonisation now as well, which we're all heading down that path by that sounds. Met coal is required to build the steel for all of that, and that's critical. Green steel is not going to be cost effective, in my humble opinion, anytime soon, or probably any time. So you're going to require, you will get more recycling of steel as things reach their natural life, but through electric arc furnaces. But you're also going to require a lot more raw material, and that's coking coal and iron ore. So we're very comfortable with the outlook. There's some of the experts suggesting, Commodity Insights suggesting maybe 74 million tonnes a year shortfall by 2040. At that point in time, the sky's the limit for the price upside. So that's why we're sort of fighting so hard, and that's why we believe this is such a good space to be into longer term.
I just want to touch on in the presentation, there are a number of key risks from slide 33 to 43. Please do make yourself acquainted with those risks, as well as in the prospectus in section 5, if you could all please refer to that.
All right, we'd like to hand back to Gareth for the Q&A. Apologies, that took a while, Gareth.
That's okay. Thank you for that, Daryl and Nick. Before I start the Q&A, I will need to read out a disclaimer, which refers to the presentation that you just gave and the upcoming Q&A. The purpose of this presentation is to provide general information. This presentation does not involve or imply a recommendation or a statement of opinion in respect of whether to buy, sell or hold securities in Bowen Coking Coal Limited. Further, this presentation is not intended to be and is not a prospectus or other form of disclosure document. This presentation consists purely of factual information and does not involve or imply a recommendation of a statement of opinion in respect of whether to buy, sell or hold a financial product. The offer of securities in Bowen Coking Coal Limited is made in the prospectus issued by the company on the 7th of October 2024. The prospectus is available on Bowen Coking Coal's website. You must consider the prospectus in deciding whether or not to acquire securities in the company, and anyone wishing to acquire securities in the company will need to complete the application form that will be in or accompany the prospectus. We will now progress to the Q&A section of the website, where a number of questions, or many questions, were received throughout the week. We're now going to address many of those questions, and any questions that, once again, I'll reiterate it, any questions do not get attended to today. They will be getting attended to before the end of the week is out. Okay, the first question I have is for you, possibly Nick. Please outline if you are raising sufficient capital and the expected time period for the proceeds to be applied.
Thanks, Gareth. Yeah, so look, I think if you go to page 12 of the presentation, we outline the sources and uses, which, as Daryl ran through, Plumtree CapEx is the key thing we're doing to set us up for long-term low-cost mining from here on in. Port and rail prepayments and guarantees, $10 million, and then working capital and cash balance sheet, $33.2 million. So I think we're comfortable that is why we've gone out to raise the $70 million. I would note, obviously, we've covered the risks. Daryl's covered the risks that are outlined in the prospectus. I would note that there are options attached to this issue. So every 2 new shares subscribed for are accompanied by 1 free attaching option for 6 months. So there's another potential source of liquidity. At the end of the day, we are in the lap of the coal price gods. But yeah, we've gone out to raise $70 million to sort of sort the balance sheet, strengthen the balance sheet, and put us into that low cost operating mode.
Okay, next question. How long before Bowen is expected to return to profitability, and do you have sufficient capital to get there?
Yeah, thanks, Gareth. Look, we haven't provided any forecast financial information to the market, but what we have done is we've provided the market with our production plans, with our anticipated costs, as well as capital estimates, and that's in order for the market to be able to form their own assessment. But I think I just want to add on to what Nick has said there in terms of additional capital. Is, if any of those options do get exercised, there's a potential additional source of liquidity to the business within the next 6 months.
Yeah, we've outlined a few other options for the company as well, Gareth, including, potential. We've got some interest in potentially selling a minority stake in the joint venture, a small stake there. So there are other options for the company. But look, our focus is entirely on getting our costs down. That's what we've been focused on. That's where we now are. And so that puts us in the best position to respond to any coal price that comes out. And as I say, we're hopeful that coal prices increase from here. We get that leverage. And we're in a strong position. We raise that money now to do the box cut, setting us up for long-term, strong, low-cost operations.
Next question. Please outline how investors can be confident that the financial results will align with company expectations.
Yeah, I think it's transparency, right? So we've elaborated on our recent production performance, our cost improvement initiatives. I think we've been fairly transparent in exactly what we're trying to do there. So we've also outlined a lot of the challenges that this business has faced and how we're actually addressing them and what we're doing to address those challenges. So we've done that in a number of media releases through the ASX, but also in the prospectus itself. So we're coming with a lot of transparency to the market, but so those are all displayed in the prospectus together with the risks that surround that.
I'll just add to that too. I think in fairness, since Daryl kind of came in the seat late January, we've tightened, or he's tightened this business up considerably. We do run a very tight ship now. We're monitoring daily our production, our strip ratio, and that's in the office down here as well as on site. So yeah, we're really tightly managing, looking for every dollar as we ran through. Those kind of cost reduction initiatives are flowing through already.
Now, the next question had a lot to do with cost reduction initiatives. Those were very much outlined throughout the presentation, particularly slide 18. Also, the capital requirements for developing the Plumtree North mine. Also talked through on slide 21 of the presentation. The next question, I suppose, is, are there any other capital expenditure during the next 6 months in brackets operational?
Yeah, I think so. I mean, that third bullet kind of talks about 80% of the capex that's going towards Plumtree North, but I think the 20% is the balance of the capex. So I think that's what's still going to come through. What we have put in previous announcements to the market in our quarterly reports, you've seen the sustaining capex is at a negligible level at the moment. It's completely manageable. So we've completely constrained capital within the business, and you've seen on the various graphs and slides we've shown you today that this is development capital that we require. We don't need continuation, stay in business capital. So we're able to generate that out of cash flow, and we are able to look after that ourselves.
Perhaps another question that's been touched on throughout the presentation. Sorry.
I guess let's jump in there as well. I think we are leveraged to coal price, both in terms of price, but also in terms of volume, and that's that sort of discretionary capex that's outlined on that table. So we can double the capacity of the wash plant very quickly. We can shift the power line, open up new tonnes in Broadmeadow East, and obviously the Lenton expansion. So there is potential capex, but it's discretionary capex that's really in response to high pricing opportunities.
Okay, next question. Perhaps touched on in the presentation once again, but probably worth reiterating. What are the new coal marketing payment terms, and how will this transition from the previous coal marketer? Are there any termination payments?
Yeah, so good question. The terms are pretty much identical to the previous coal marketer. They're sort of market-based terms. Termination payments, as I said earlier, there's a 12-month tail, which will sort of end up with a double up on effectively for parties introduced by the previous marketing agent. Although there has been, I think we've released the fact that Square have given us some grace on that, depending on gold price, so we'll potentially avoid some of that as well. But no, look, we're very excited about the transition and the ability to really kind of pump this coal into the market at the best price possible from here.
Next question: are there any other board changes or additions expected in the near term?
Yes, well, you've probably followed the EGM sagas, Gareth, but look, those EGMs have now been pulled by the proponent. Look, I think our focus has been just let's get the business on a steady footing. We've done that now. The business is operating really well. Credit to Daryl and the team. A hell of a lot of work's gone into that. Now let's get the balance sheet stable and strong. So we've done that by renegotiating our debt terms, bringing down the cost of our debt and wiping out things like acquisition royalties. This equity raise is the sort of last step in that to put us on a very strong footing, and then we'll make other decisions from there. I think we would recognise that in due course we need to strengthen the board and continue to look at have we got the right skill mix, but there's been no announcements, no decisions made about that at the moment.
Next question. Please elaborate on port and rail commitments. Has Bowen obtained firm port and rail allocations?
So I think the answer to this is lies in the last bullet over there. So we have been working on short-term sourcing arrangements for both rail and port, and we'll continue to do so. So we're finding that it is freeing up somewhat within the system. In fact, it's probably freeing up a little bit more than what we thought originally. So we've done a lot of hard work on that, and we'll continue going along that path at the moment. So avoiding large guarantees that have to be placed for circa long-term rail and port. So we're finding a bit of a balance at the moment, and this is working for us. So we're obviously staying on the front foot as far as we possibly can in terms of rail and port, but certainly we're definitely finding our way to market.
Please outline if there are internal inventory liquidity buffers to be able to sustain disrupted production/sales, example due to a weather event comparable to the last couple of summers.
Yeah, I think we've outlined our stocks certainly at the end of August. So ROM stocks were healthy at 154. So we circa mining 250 kiloton a month. So that's just over two and a bit weeks, which is more than enough for the wash plant. And you'll see Ellensfield South Pit is open. It's not like we've got a lot of waste to move to get the coal out of Ellensfield South. So we're very focused on that. ROM stocks are healthy, and the product stocks are healthy too. So we've outlined 244,000 tonnes of stock, which is more than a month's supply. Circa it's 1.5 months of sales that are actually sitting on the stockpiles at the end of August. So we've got healthy stocks. And we're positioning ourselves now to be able to cater for wet weather. So as I said earlier, we want the ROM stocks to be in front of the wash plant, so when it does rain and mining is potentially interrupted, we can carry on running that wash plant. And we're starting plumtree now to avoid the wet season, to largely avoid digging a box cut in the wet season. So we're starting that now in the dry season. So I think the pipeline is a lot healthier than it used to be.
Spent a fair bit on haul roads as well and making sure they're in tip-top shape. In advance to the wet season. And as Daryl says, I think the wash plant keeps going when it rains, and so it's about keeping those stocks up and making sure that we can come back quickly from any rain event, which is what we've done.
Nick, you touched on pricing earlier. Has the new China stimulus changed the short-term price outlook for hard coking coal?
Yeah, interesting question. I think we definitely saw a sort of an uptick in Chinese prices, and that's continuing. That's flowing through in the physicals now. Obviously, I think on the weekend there was a bit of disappointment that maybe there wasn't a bit more coming down the pipeline. Look, my view on this, and there's probably no right answer, but we've definitely seen it kind of come off the bottom, and we've seen that over the last month. I'm not sure that's so much about China as about just it was. As I said to you, there are a lot of guys bigger than us whose cost bases are probably higher than us, and at that point, if they're struggling to make a lot of money, that's a difficult situation to be in. So that tends to kind of push the price back up to above the cost curve sort of level. So I think we're at the start of that. As I say, there's still some room to move. Certainly in the future pricing looks like another sort of $35 through to January, potentially Aussies on the PLV market. And then we've got seasonal aspects as well coming on top of that. So India, finally coming out of monsoon and starting to buy stocks again, I think will be helpful through to the end of the year, and China sort of sorting itself out with a little bit more construction and taking some of that excess steel off the market. So look, overall we're quite bullish in the sort of near to medium term, and I guess extremely bullish in the long term, as we've just seen. A number of mines have come out of production. Seen Grosvenor now. Obviously, some of our other neighbours, Fitzroy struggled. A few mines have struggled to meet their production requirements. Some in the US as well. And we think the market is sort of tight as a drum. It's tightly balanced. Obviously, there's been a fair bit of coal around in recent times, but I think that can turn very quickly.
Are there any material capital items in the coming 2 to 3 years which haven't yet been disclosed in the prospectus?
Well, I think we've got the capital items covered on the right-hand side of this graph. I think we spoke about that during the presentation. I think all the expansion capex is there. The Circuit Stay business capital is all been spent. So it's only expansion capital or enabling capex. So I think we've covered that, Gareth.
Has the company engaged with larger coal industry players surrounding your operations, and where synergies may be useful to both parties around potential equity participation / ownership?
Yeah, good question. So we have, as we announced after we bought the Burton Complex, we have arrangement in place with AMCI and Fitzroy around sharing of infrastructure. So we were able to utilise their wash plant when we started up our operations before we got how it's going. They're in our camp, they're in our haul road. So we do that. In terms of equity, I think it's public that Hans Mando took an equity stake in the previous cap raise, and so there has been some of that going on. But look, we talk to all of our neighbours and all of our peers on a regular basis, and that's just ongoing. So yeah, that's absolutely occurring.
Question 14, perhaps answered earlier as well, but it can't hurt to clarify. Please clarify on the debt payments schedule, and when are payments due, both principal and interest?
Yeah, I think thanks, Gareth. I think on slide 10 it clearly outlines the AWOL profile. So that's the principal profile. Interest is payable quarterly at the end of every quarter. So I think pretty easy one to answer that one.
AMCI has appeared on the register, but they haven't yet shown interest in leading an equity rescue package. Could you provide some insight into why that might be?
Look, I'm not going to speak for AMCI, Gareth. I think that they make their own decisions. Obviously, as I said to you, they did participate in the last race. We'll see what happens this time around. Beyond saying that, a lot of coal companies, our peers and our neighbours are struggling with their own issues at the moment. So I think I wouldn't read too much into any of that at the moment.
Okay. What is the company's marketing division telling you about the near-term demand for Burton Coal and pricing?
Its marketing division might be a stretch, but we certainly work closely with M Resources and now with Square. So look, I think we don't have a crystal ball. Obviously, we're focused on the things under our control. But I think what I would say is that as I have said, is that we're bullish. I think the big steel mills in Japan, Korea, and the rest of Asia, are expecting spikes in prices to occur again. And just driven by the fact that there is existing mines are getting more expensive, deeper, harder, and it's harder to start new mines. Obviously, you've got a lot of regulatory hurdles, from royalties to approval times. I mean, we've got recent mines in Queensland taking up to 17 years to get their mining lease approved and all of their other approvals. I think when Jellinbah was done in 1996, it was 7 weeks. We've certainly got some work to do with governments to improve that, and I think that's very possible. But I think it's that lack of supply that people are worried about. You're seeing it with Nippon, and I think JFE buying into Blackwater now, taking a stake in that asset at a pretty healthy price just to secure their ongoing supply. Because all of these guys, whilst they say, they want to get to net zero, coking coal stays a big part of the mix, right? It's a big part of the mix when they're realistic. They recognise that, replacing it is not on the cards with anything like green steel. It's just not economic and not going to work. So I think they're all looking hard for more sources of coking coal supply, which drives them to say, well, we've got to. When 2008, 2009, I got to $300, everybody had a celebration that lasted about a millisecond, came down again. We had it again in 2016, also $300 US. And then more recently, 2022, we got to 670. Nobody saw those things coming before they happened, but I think the numbers I'm hearing now on the upside are bigger than that again. So we'll just see.
Please elaborate on the deferred royalty payments. When are these due? Can it be deferred again?
I think there's a slide in the pack right at the back that shows you the profile of the deferred royalty plan. So that shows you when the payments are made. The bar graph on the left shows you the amounts, including interest, the principal amounts on the right-hand side. And I think it's pretty clear about when what is due and payable. And just to answer the question about, are they going to be deferred again? Well, we haven't asked for that yet. So we haven't asked for any further deferrals other than what's presented on this deferral plan.
Yeah, I think at the risk of going off script here, I'm just going to say that this is a disaster for the industry. It's not been well. There's been no consultation on these royalties, as people have heard. It is very difficult to start new mines, as we can testify firsthand to, and the fact that we've sort of incurred and paid circa $100 million worth of royalties already before we've made a meaningful profit, returning to shareholders before we've even serviced our debts, regardless of whether we can pay our bills and pay our wages, I think is a travesty. I think this has to change, and I think in due course we will see some common sense prevail on this. But this is you well know I've been passionate about this. We've started Coal Australia. That is an industry group, but designed to promote the industry and unleash the pride. Coalaustralia.com. That we've got nearly 10,000 people signed up, supporters. We encourage everybody to get on that. The only way we're going to make change here for our industry and for common sense outcomes is to pressure governments. Governments listen to voters. Once we've got a bunch of voters already, that's how we'll get effective change in this.
All right, thanks very much. Not a bad way to end a presentation. Bit of front forward play, Nick, but certainly the presentation today certainly outlines the buoyancy and the positive outlook that you're sharing for the business. To everyone who's asked questions today, thank you very much for submitting those. We've tried to answer as many as we can today. Certainly any questions that remain will be answered throughout the week. So I'll, without any further ado, I'll call time on this meeting. Yes, thank you everyone for the participation.
Thank you.
Oh, and there will be a recording of the presentation for anyone who'd like to go back over today's presentation or share with anyone else.
Thanks, Gareth.
Thank you.
Thank you, everybody.